Australia's home prices hit record highs, and unfortunately for those who bought at the top, they purchased with maximum leverage and are now in the most debt they have ever been in history. Australians, just like their counterparts in Canada, have overextended themselves to the point at which they have invariably created a crisis they can't escape. You came here for the truth, so let me unveil that for you. Hello to all my friends in Australia. This video is for you. We're going to get into the crisis which has unfolded that most will not pay attention to, but that's why you came here. My friends in New Zealand, I finally have some information for you. I'm going to share that with you today. And of course, we're going to talk about Canada. We're going to talk about areas all around the world. I have so much data to cover in this one. I don't know how I'm going to do it. Hopefully, I can put this into one video. Let's be very quick. On the right-hand side, I have a chart. It's showing us the core logic numbers, all right? Sydney is down 7% year over year. That brings it underneath the $1 million mark. Now, let's not kid ourselves. $1 million for a home is still very significant, but 7% year over year, that's a trend. That's not a mistake. That is, in fact, a slowdown. So let's acknowledge what it is. We have a slowdown here. The peak is over, and the government, the central bank, is trying to tighten. So we can expect that this will continue, and that is the goal. That's what they're trying to do. It's not like they're trying to inflate it further, although we can argue that as well, but at least on the outside, on the surface level. All right, so we have tightening going on today. They're trying to make it a little bit more difficult for people to buy homes. We're going to discuss more of those details here, but when people are buying homes at $1 million a piece, knowing what people make, what they earn, and knowing how much debt they're willing to take on, we have got a crisis. And that's really the subject for today. Let's show you this here. Australian housing, overvalued and overleveraged. The red line is the combined price to income and price to rent valuation. I love to see these. I talk about these in my book, in fact, my first book, and it's an important indicator. You'll see the trend here is clearly going skyrocketing high. This chart starts from 1988 to present. I'm going to show you the article that goes along with this as well. But I want to get rid of the jargon. I want to make this as simple as possible. When people see this, what's a price to income, ratio and valuation? What is this guy talking about? It's pretty simple. Let's just call it for what it is. What does the average household make? And what does the average house cost? That's it, okay? Let's not beat around the bush. What does the average household make? Maybe it's one income earner, maybe it's two people, but on average, throughout Australia, compared to what the average houses cost. That's it, okay? And today, that number has accelerated far beyond anywhere it has been in history. And you have to understand, this is, think about it. What a house cost back in the 70s. I know that many of my subscribers purchased homes back in the 70s, and they tell me what it was. They tell me what they were getting in their salary. And today we've got a big problem. It's clear. You're supposed to, historically, pay 3 to 4 times the median household income. That would be what your average house would cost. 3 to 4 times the income. Let's say together, maybe your average household income is 80 grand, 3 to 4 times that. Today, that's not the case. That is not happening at all. It's more like 10 times. So we have seen this number. I mean, depending on the city, these numbers are going to be completely different. But no question about it. Looking at it back in the 70s, looking at it back in the 80s, 90s, and so on, the number just keeps getting more and more out of whack, and eventually, this has to stop. Household debt percentage of income, you're going to see that as well, going to levels, again, never seen before. The alarming debt graph that shows why many young Australians will never own a home, as Sydney is rated one of the world's most, quote, overvalued cities, and that's according to The Economist. Australian household debt to income ratio now stands at a massive 189%. That is a huge jump from 1988 when borrowings made up just 60% of their pay. It has accelerated so far. And you can make an argument, is this really the best indicator to see and how we can look at it? To me, it doesn't really matter. It's just one indicator. It's just one. There are so many. There are so many. Let's not get fixated on this is the indicator I have to follow. I have to look at the S&P 500 to determine if the stock market is overvalued. Because if it hits a certain number, well then it's overvalued. But if it doesn't hit that number in a certain period of time based on moving averages, then it's not. That's not the way I look at things. I use as many as I possibly can. Some of the very technical indicators, and then I look at more the anecdotal evidence, and I want to bring those together, and I want to bring that to you. All right, so let's cover this further. I mean, I have so many things. Actually, if you want to see an amazing interactive chart, check this out. It's out of The Economist, Global Cities House Price Index. All right, we're looking at this here, and you can drag this. I don't know if you're going to be able to see, but if I drag this across, I can see the percentage increase in these cities, which I can choose from the list. I chose these two, obviously, because it pertains to what we see today. But Sydney, for example, house prices in Sydney are 113% higher now than they were in Q1 2009. 100% higher. The same thing for Melbourne as well. 100% higher? That is ridiculous. This isn't some sort of penny stock. We're talking about housing. And that's just in less than 10 years. Housing is not supposed to do that. It's supposed to be steady and stable. Why? Why should it be steady and stable? Because people, they're graduating from school, let's say, they're coming into the workforce, they save up some money, they buy a house. But if house prices are increasing at 100% per decade or less, they'll never be able to afford it. That's a big problem. Not that you have to buy a house. You could certainly rent. However, it should be affordable. And we've got a problem because all that does is push the rents up higher as well. Okay, so if you wanted to, you can go through this list here and take a look at different cities. You know, whether we look at Hong Kong, I mean, it's ridiculous. This is just ridiculous. Hong Kong is up 255%. Looking through here, I mean, if I know I have friends all over the world, you could see New Zealand, again, 124% here. Okay, so that's an interesting one. I will have the source in the description, but I think if you type in Economist Global Cities House Price Index, you'd be able to get this, all right? And maybe the word interactive also. Now, this does not correspond to the other CoreLogic data that I was seeing. Now, this is actually from wolfstreet.com. They're using their data. However, they're showing us here down 5.5% since September of 2017. So I don't know where the peak is necessarily, but let's just forget about percentages and let's just say what it is. The prices have come down. This is Sydney. This is Melbourne, as we see. Again, not as significant, but prices have fallen. Growth in Australian home loans for investment hit record lows in June as tighter lending standards and hikes in some mortgage rates sucked the life out of the buy-to-let sector, piling further pressure on house prices. That's huge. That is huge news because they need more and more and more and more lending. They need people to take as much debt as they possibly can. Even when they're not able to, they want to give it to them. There is so much fraud going on today. It's unbelievable. I've heard of the stories that goes on, and it's just simply, it's unbelievable. I don't know how they're allowing it other than they know they're just turning a blind eye. And the same exact thing was happening in 2007, leading up to 2007. Tuesday's figures show that the stock of outstanding credit for home investment fell 0.1%, not much, from May, but that's 1 month. That was the first drop since the global financial crisis and only the third decline in the near 30-year history of the series. Only the third time it happened in 30 years. We've got issues. This is just one of them. Again, just one indicator. A lot of people like to pigeonhole and say, oh, that's just one thing. Don't look at just one. You're not going to get the full picture if you look at just one thing. Annual growth in investor credit slowed to an all-time low of 1.6%, a long way from the 10% plus seen at the peak of the housing boom in 2015 that dragged growth in overall housing credit down to a 4-year trough of 5.6% and so on. Okay, let's move on quickly. Here is a bearish chart for anyone looking for a real estate job in Australia. I'll show you the chart in just a second, but wanted to just show you Australia's housing market has entered a downturn led by weakness in Sydney and Melbourne. House prices, auction clearance rates, buyer sentiment, new housing sales, and housing finance are all starting to decline, indicative of cyclical downswing, currently underway. You can now add job ads to this, being, for the real estate things you could see here. Seek new job ads, real estate and property declining throughout 2017 into 2018. We'll see if it has an upswing as a result. I don't expect that, of course, as the prices are coming down. I talked to an individual here in Toronto just recently who has now decided not to do any more investing for the time being in real estate, thinking that the market is a little too slow. It's not as hot as it was. So he's having a little hiatus on that. So just an inside baseball, as they say, from an investor. Australian property industry turns to India to supplement falling Chinese investment. I've heard a lot of people tell me, oh, the Chinese are buying everything up. Well, not exactly. The amount of Chinese cash which once poured into Australian property has about half, okay? Leaving developers and agents scrambling to recapture the record volumes of investments. Okay, so it's not saying that they're not doing it. It's just saying that the amount is half. Okay, I hear a lot of people acting very silly and they say, oh, I don't know what you're talking about. People are still doing it. Yes, but these are the figures. These are the facts. I can only go by the facts. I can't go by, I don't live there. I can't tell you what they're seeing. A joint report showing that the industry interest is selling off the planned property to Chinese investors declining. It was increasing in the surrounding growing economies. Interesting, to say the least. Now, my friends in New Zealand, very quickly, just wanted to cover this. Foreign buyers accounted for up to 13% of property dealings in popular areas between 2015 to 2016. But this year, the report into the Australian housing market found foreign investment fell by 2/3 during the 2016-2017 financial year. And what has happened recently in New Zealand is that they banned foreign buyers. They wanted to halt the property price increases that were happening as a result of foreign investors coming in and pushing up the prices. So they literally banned foreign investors. Now, there might be a way to get around that. Perhaps they're opening up corporations in New Zealand and then doing it through some sort of shell company, some holding company, and finding a way in. But it makes it more difficult. Maybe there's more scrutiny. There might be laws around it. I don't know. I don't live in New Zealand. I'm not a lawyer. I'm not a tax attorney. I'm not aware of all the details, okay? I'm just saying that maybe it's still possible to get around it, but it's going to be more difficult. And of course, the same issues are happening in New Zealand today. Property prices are ridiculous. Property prices are unaffordable to the average person. But if you have purchased a home, whether it's an investment or it's your own home, then somehow people feel rich because of it. I think it's really silly, and I'm going to have a feeling that in the near future, people are going to realize why when it smacks them right in the face. All right. If you found the video informative, please give me a thumbs up. If you hate my pronunciation of Melbourne, give me a thumbs down. Thanks very much. If you want the financial education you were not taught in schools, these two books have it all. If you want more of the details about all the ratios and all of the specifics about real estate, then my book, The Money GPS, is probably the one for you because I get into those. I explain those. But I also cover real estate in global economic collapse. I cover it in a different way. So the way that they're written is basically the foundation, the history, the asset classes. That's all in the first book, The Money GPS. But global economic collapse fills in the blanks. Okay? So check them out. Link is in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.